here's like the bear trap you set for yourself, because no matter what a company in your portfolio does, you should not, as an investor, feel like emotional and distraught.
This is the hard part. For all our listeners, this is really the gray area, what makes investing such a challenge. Because I follow these guys for so long, I actually like them.
I don't know what your number is, but you should have a hard limit. And you're like, I will never let any stock get above X%.
If I let the fear right now overwhelm what I think is a clear, huge opportunity to invest in this market.
For an advertising-free version of this show, check out wallstreetwildlife.com.
Welcome to the Deep Investing Jungle with your hosts, Luke the Badger Hallard and Krzysztof the Monkey Pakarski. This week, what the hell happened to EOS? What the hell happened to Oddity? And why the hell has Mercado Libre gone nowhere for 5 years? This is a good, the bad, and the ugly episode.
Badge, just reading those headlines, it feels like we've got the ugly, and the ugly. So we got our work cut off for us to at least find something that's not outright ugly, and then hopefully, pivot to, some silver linings and find some good amidst the rubble. I've been thinking hard over the last, 5 days, I guess. EOS earnings came out on the Thursday. Oddity had their complete disaster earlier in the week. So I couldn't wait to record this episode to offload, a lot of whatever's going on up in here. And people
I'm your podcast co-host. I'm not your psychiatrist.
You are today, buddy. You are today. You have a box of Kleenex for me?
I do.
In fact, a lot of people, have been asking me for what's my take on the EOS especially, and I have refused to say things so as not to dilute all my thinking. So yes, you're going to get it all. And I think this is what's going to be interesting. I legitimately have decisions that I'm thinking through that I have not acted on. And this is why I love it when we do it this way. I'm going to tell you my choice points, what I'm considering. You're going to give me some hopefully useful feedback to consider and see how I end up navigating some stuff.
And I'm going to give you a hard time on EOS because you did post a pretty big missive to the Patreon the other day, telling us about your thoughts as the news was dropping. I haven't fully absorbed the news, but I've got some concerns about the way you're thinking about the company, but we'll get to that. Before we do any of that, shall we at least do a tiny bit of the good?
A tiny bit of the good up front to not scare, to not terrify our listeners? Sure. Give us a taste of some honey before sure.
Yeah, there you go. Perfect. So we made a list of the top 20, top 25 best investing podcasts in the world, and we're number 19.
Now, what kind of mom and pop shop that's us in the top 25? How much do we pay these guys?
Yeah, so PodRanker, who there are a bunch of these podcast outfits out there, and to be honest, they might be a little bit self-serving in trying to drive traffic to their own site. Nonetheless, we made number 19 on the list of the top 25 best investing podcasts in the world. And it's actually a pretty legit list, to be honest. Apart from us, randos at number 19, you got We Study Billionaires, which is 180 million downloads. They've been going for well over a decade. Motley Fool Money, Invest Like the Best, Animal Spirits. And then there's us in position 19. So we are now legit.
Yeah, we're a thing. Right. I was looking at this list skeptically at first, but because of the company we're in, that alleviated some of my concerns. You know what else is exciting about this badge? In the world of finance, I imagine it's not a niche field. This is a massive market, so to speak, because it helps people make money. It's not about knitting, or crocheting. No disrespect to the knitters and crocheters among us. So I don't know, in my own head, I'm like, there must be now like the proliferation of Substacks and, individual analysts on X. I mean, there are thousands, right? I mean, there's no shortage. So even to make a list like this is legitimizing. So that is excellent news.
Yes. Well done. Well done, Krzysztof, for being part of the team that made number 19 on PodRanker's list.
Excellent. Well done, Badge. And as we were talking a little bit before the show, I think this is more incentive for us to get even better. Right? I mean, on YouTube, we're at like 5,000 something subscribers. I think when I listen, maybe this is a little bit of a tangent, but as far as inspiration goes, there's many incredibly wonderful shows or podcasts where for several years, right, they're trucking along, giving value so their audience finds them little by little. That's been our pace, right? And then all of a sudden, there's a massive inflection point because they kept trying to get better and kept, and it was already in the wall that we had enough. That's where we're at, right?
Right. Yeah. We can, just getting 1% better every episode makes a massive difference in the long run, right? It's compounding applied to our podcast process.
Yeah. So I'm excited. I've never been more motivated, to be honest. Not only, there's lots of forces aligning for us. The Wall Street Wildlife University, we have the community portfolio. Our Patreons are alive and bushy-tailed. I mean, we're killing the market despite all the ugly nonsense that happened for a lot of our holdings this week. So we're thick and thin, right? I'm excited to keep going and keep getting better.
Yeah.
All right. Badge.
That was the good. Now let's start the bad.
So let me offload to you the facts. Let me paint the picture. I think this deserves a full background. So it's only 95 days ago where the November earnings call, where EOS had their November earnings call. And on that call, 30 days into the quarter, they were basically as bullish as I had ever seen a company be, including not just the CEO, but the chief operating officer, who is a world-class operationalist they brought in to basically make their battery lines even better. And they were talking about how quickly they could expand. Okay, so then you have that bullish call on top of every last tailwind imaginable in the age of AI, tax credits and tariff protection and data center demand, and they're linking up partnerships. So all the issues around demand basically were being more or less put to bed. The thought of selling, as a long-term investor, the thought of selling in this moment would only have been for portfolio management reasons. And if you remember, I actually sold one of my calls at a very big profit for that reason, but it was not because, I wasn't trying to be cute. I was trying to manage an oversized portfolio. So that was a correct decision. But mind you, in hindsight, everything else is obvious, but that's why I'm trying to reiterate this narrative. There was zero reason really in that moment from what was known to get funny and cute. Also, let me add another point. One of the powers of X, the EOS community, especially the OGs that I've been on this journey with for years, got really sophisticated in the kind of analysis they were bringing to the table. And one of the data points was how much felt shipment EOS was receiving weekly. So that was another data point to track. And they were increasing their shipment. So you don't keep buying more and more product if you have nothing to do with it. So basically, all of which is to say, all the data available was to the upside. Lo and behold, we get earnings on Thursday morning. And, sorry, I left out the most important piece. So they reiterate guidance 30 days into the quarter. The thinking on the investor's standpoint was, you don't, unless you're an outright idiot, you don't say you're going to meet lofty guidance unless you're very confident you could meet it. Fast forward to the earnings call. They miss massively. Guidance was expected to be 92 million. They came in, I believe, 58. Whatever the number was, it was 30 or 40%. The point is they missed by a lot. So here's where so in that moment, on Thursday morning, I'll speak for myself. I felt incredible anger, and I felt betrayed. And I was left with, what the hell? Like, how could this be? So as an emotional animal, one of the first things I went to was, they're liars. Borderline, potentially criminal. I'm sure they're going to have lawsuits. There's no doubt. I don't know how many will be effective because, but the law industry will no doubt have their turn at this kind of thing. But I also noticed that, yes, that's my initial, reaction from massive losses that probably could have been avoided. So I'm naming it to you. Management, it felt like, yes, a betrayal of management. How could you lie to us, right?
And I am going to be your psychiatrist a bit, because you're using like dangerous emotional language. And obviously, that's like a reflection of what you're feeling inside. But even irrespective of what the management team allegedly did or did not do, like, to feel those emotions is probably unhelpful for you as the investor. And that probably tells you were probably too overexposed.
Oh, yeah. Well, let me continue my narrative. Yes, yeah. I'm just narrating this, from the point of, one, truthful vulnerability, as this is what my process has been over the last 5 days.
Right.
That was my animal reaction. That's why I'm naming it. To your point, if this was only a 2% position, I would never have those feelings. Right? But my style was go big in the things I'm confident in. Right? So that's why when I feel betrayal, and there's a lot at stake, anger, betrayal, all those things come up naturally. However, here's the important point, I think, as I continue narrating this. Over the next 4 days, I want to bring in some color, some granular details here, and ask you whether it was management betrayal or even criminal activity, or whether this is, call it as a really awful gray area. So here's the facts. What is it that seems to have happened? On the call, they named 3 things. One is that they ran out of supplies. And so they could not make the batteries because there was a supply issue. It obviously seems to me that happened after the earnings call. So call it wildcard number 1 shows up. 2, as the line is now running at full capacity, they have an issue with bipolar yield. Translated, that means the batteries ain't coming out so good, and they had to make adjustment to some of the tooling technology. So that reduces the yield. And ultimately, that ends up with a 30% downtime of that one line. So they were not making the batteries fast enough. They did not know this. Well, here's the thing. They could not have known this on that call. Otherwise, if they actually still reiterated guidance, that would have been absolutely just insane. So we could reasonably deduce this all happened basically sometime in November and December.
And because I'm a bit fuzzy on the timeline. So we're in start of March. So the earnings call was the end of February. So the prior earnings call was what, the end of November?
November. Yeah, early November, I believe.
Okay, early November. And then they reiterate guidance like early December. And then February, they dropped the bomb.
Well, no, the guidance was created in November. So they had October's data. So everything's going fine in October, but something happens basically in November and December, right? Now, here's the thing. This is a ramping operation, right? This is doing a very difficult. Manufacturing is hard. That's why there's no battery makers in the United States outside of Tesla, right? That's succeeding. That's why there's such huge stakes here. That's not necessarily the issue. What I was left wondering all weekend long was how management could have, what ought they have done instead? What they chose to do essentially is, I'm calling it lie by omission, right? Like, I'm not doubting that they already knew this stuff was bad and then they outright lied on the call. That seems implausible. But what they did not do is issue a kind of, I guess, warning mid-quarter. And they more or less went along as though nothing is happening. And the bad taste in a lot of investors' mouths is that we also saw some insider selling in late December. One of the main holders sold massive amounts of shares.
Yeah, Beaver picked that up and tweeted about it a few days ago. That seemed kind of ugly to me.
Right, it is.
Who was that? Like, of all the insiders, who was the main seller?
I believe, I'm going off memory, I believe he's a board member, 10% owner.
Okay, all right. So, but not the CEO, not the COO.
Correct.
Okay, fair enough.
So I'm trying to now be reasonable here. And I thought about what happened with PayPal as an analog, because PayPal was beaten down badly. There's talk of things recovering. And then the CFO goes to some conferences and says, this ain't going to be a good quarter. And the stock goes down further. And I'm thinking, okay, that's one way of handling it. Your stock still goes down, but at least they're being upfront, right? The issue here now for a lot of investors is in a difficult moment like this, it was going to be bad news either way, right? Whether you give a warning or you wait till the earnings call, the stock's going to drop. But by not saying anything, then going to Davos and talking about all the future products, now we're left with the inarguable point that when they issued guidance of 300 to 400 million for the full year, in what world do we believe anything they say, right? Knowing that they might be lying by omission. Now, to be honest, my take, and maybe this is what listeners want to hear, is that I think this was the whole throw all the bad news out there as fast and directly as possible into the earnings call. Now they start lowballing things and they flip the place, they flip the script, trying to then rebuild the lost credibility. That's, I think, what's actually happening here, most likely. But
just sort of fact check that or help us ground it. Like, have they just dumped a load of bad news? So if they've now set out guidance for 300 million, is that very conservative or is that still quite optimistic?
That's very conservative, because if you add up the megawatts that one line that's running could produce, it should be easy to get to 500 million, let alone the fact that they have a second line intended to be raised halfway through the year. So that's an incredibly low guidance. Basically, that's what shocked Wall Street. But that's why, this is tangential. That's why right now EOS is, again, a really compelling investment. However, that still circles me back to what I think you and I were discussing on Patreon a little bit. I'm trying to legitimately determine whether this is a kind of management team that is out, like, I would put them like bad actors, right? Bad, like liars, bad actors, just willing to say whatever needs to be said. If that's truly the case, I want nothing with a company like that, right? And that was your point.
Yeah, that's good to hear. Good. If that is how you believe, if that's what you believe about this team, even if the company is like on the precipice of like doubling because of, you know, some incredible catalyst, you just don't want to be on that journey. You don't want to make money that way, because who knows like what rug they're going to pull out from under you in the future.
Absolutely. I am in full agreement with you there. I mean, it's just a nasty thing. You can't sleep well at night knowing you're kind of in bed with criminals, borderline criminals, right? I mean, and this is the hard part. For all our listeners, this is really the gray area and what makes investing such a challenge. Because I follow these guys for so long, I actually like them, right? There's something about, the CEO and like is maybe a hard, maybe that's not the right word. They're salesmen, right? So I like how they sound. There's something about them that feels, I hate to be squishy about this, that feels decent and hardworking, and they're trying to build this big company. And so I'm trying to square that away with, were they put in a position that was bad either way, and they chose to take what I would call the ethical route because they were going to be screwed regardless, for the benefit of the company, short term, at the expense of shareholder trust. That's, I think, what happened, and it's really uncomfortable, but I'm not sure that's the same as, you know, the first bucket of malfeasance, you know, outright malfeasance. So I'm left with, I'll turn it over to you, you know, like I was tempted to sell, then I regained composure. I'm not convinced that's the right move at the moment.
Like what are brass tacks here? Is the leadership of the company trustworthy? And, you know, like is what they did, is it kind of like a white lie to protect the company, or is it just like, well, I don't know, whatever the opposite of a white lie is, like literally just, like pump and dump whatever they can to enrich themselves, or, you know, do like manipulate the stock? Like, where is it on that paradigm?
This is why, yeah, the details of this seem to matter to me. Bad news hit after the call. That didn't seem to be a pump and dump to me. That seemed they were genuinely enthusiastic. As I said, the data were all really positive. The bad things happened. And now it's a matter of basically letting the market know. And when I talk about Oddity, by the way, small preview, we're going to revisit this very thing again. Is a company required to always report the bad stuff immediately? Legally, obviously, no. That's what the quarterly earnings calls are for, right? But here's the thing. I think of a counterfactual now, Badge. Let's live in an alternate universe where they do send out a PR that says, look, early December, suppliers and our line is now down 30%. So stock plummets, right? Probably, whatever, 25%, right? Not good. But now we get to the earnings call late February, and they this time say, look, we had a really rough go the last 2 months, but lo and behold, we fixed all the issues. Because they did. And now we're here with, yes, the stock is down much lower, but at least trust is still intact. And now, right, the perceptions are from what the hell is this to, okay, these guys are going through another difficult period, but they fix things and it's investable still. So almost like a complete inversion. I don't see why they don't get fired. You know, this is, I would say, a fireable offense if I'm the board or Cerebrus, right? So why didn't they fire the guys? And I think ultimately, probably, they know them better than I do, obviously. they probably don't think this was the kind of corruption level bad.
Or like the writing's on the wall and the board is like the regulators or the market or the lawyers are going to deal with this situation. Like we just need to, let's just kind of hold the party line and see how this blows up. Because you're not going to throw your own CEO under the bus publicly until you have a very clear position.
Well, curiously, PayPal did just that. They fired Chris because he was very rah-rah. He was seemingly turning, there was a lot of enthusiasm, and then the numbers came in and that earnings call just got rid of him.
PayPal's like an established giant. EOS is essentially like mostly pre-revenue, right? It's still a very young company. Firing like a key leadership role could potentially be fatal for a company like EOS, isn't it? Well, probably almost certainly isn't fatal for a giant like PayPal.
Right. Well, small correction. I mean, now I know everything's relative in size. They did make $100 million, and they're the first, non-lithium battery company, battery energy storage system company to have achieved.
Fine. Sorry. Okay. Not pre-revenue, but super tiny, still fragile company.
Yes. Your point is still stands. Getting rid of a force midstream is foolish in many ways. So ultimately, Badge, here's the thing. I'll put it down to a binary choice. If I, to your point, believed that this is a corrupt management team, my decision should be to sell. I think, unfortunately, for better or worse, this is enough of the gray here where I'm gonna calm my tits. I'm gonna let the difficult emotions pass, and I'm going to give these guys one more shot to prove themselves over the coming year, assuming, for better or worse, that they were now honest with us on the last call. They gave us all the bad news all at once. This is now a full production issue, which they solved. And hopefully it's now under-promising and over-delivering going forth. If they screw this up again, then I'm out. Meaning not production, but the communication.
I think that's all fine. Now I'm going to loop back to that psychiatrist comment I made like 2 hours ago. Because what you said is correct. And if you believe that it's
fraud...
my
Kleenex? You got my next.
Yeah. Like if you believe it's fraud, 100% agree with you, you should be out. If you're willing to give them a bit more rope, then that's, your prerogative as an investor. But here's like the bear trap you set for yourself, because no matter what a company in your portfolio does, you should not, as an investor, feel like emotional and distraught and like strung out and I've made a mistake and, how dare these guys do this to me? So that's not them. This is now you. You've got to look inside. And I'm afraid it does come down to portfolio allocation. Because if you have such a meaningful amount of your wealth, like your future, you and your family tied up in this management team, well, that means you're suffering the consequences of their actions. And you should never let yourself feel like that. And so that's, if for no other reason, that's why you should be managing your portfolio exposure, so that if something really goes wrong with a core holding, you're still like, okay, these are the facts, but I can keep my emotions kind of contained.
Yeah, I agree with you 100%. This is a hard one because part of the reason the allocation was so high was because my gains were so high. It's very counterintuitive. One, you get into paradoxical stuff quick, Badge. It's not like I'm disagreeing with you that smart portfolio allocation is mandatory, and simultaneously, the position became so big because the growth is so big. The don't sell, right? We talk about this all the time. If you find a winner, let it run for 5 years, 10 years, right? You let it go. And also tax implications, right? the selling out 800% gains, the tax bill is massive. So I'm saying it's not so simple as I didn't trim because I got lazy or.
Nah, you're making excuses. It is that simple. You should have, I don't know what your number is, but you should have a hard limit. And you're like, I will never let any stock get above X%. And for me, it was 20%. Now it's like 15%. You should work out your own number. Maybe it's 30, 40%. Like you've got your numbers unique to you. And like you should never let the tax tail wag the investing dog. That's always a mistake, right? And it's one of our laws of the jungle, right? Your emotions, fear, FOMO, greed. If you're saying, well, it's all, you're essentially saying, without saying the words, it's house money. I started with a small amount, it's up like 800%, 8,000%, suddenly it's this huge number. And you're like, because of that, I got to let my winners run. You're triggering a whole bunch of investing fallacies that we have documented as part of our laws of the jungle. You got to go reread them.
Yeah. Here's the full picture. Actually, the King of the Jungle portfolio is a good mimic of my real world portfolio. So I'll just stick to that. I did trim along the way, is the irony, but it kept going up. So it's not that I was ignoring the laws. It's that maybe I wasn't aggressive enough. My number used to be 25% max. So maybe that is the violation that right, the trim should have been even more aggressive. In hindsight, obviously it's clear when the company is so damn bullish and everything is bullish, and I keep reminding myself of the other thing, like don't sell for no, just because you feel something. So it's your point is true. I acted partially on the things you're talking about, just not enough.
Right. And that's not, when RIM Rocket Lab was on an absolute tear, I was literally looking at it every morning and just saying to myself, like, am I overexposed? And I think I sold, on like a Monday, and I sold again on a Thursday. Like I was that on top of just managing my exposure. Because I'm like, I don't, like, if Neutron fails, if something goes wrong, if Peter Beck, dies in a helicopter accident, I don't want to be going, oh my God, like how I'm such an idiot. I just want to be managing it proactively.
Yeah, so you're right. And I violated the laws of the jungle partially. I would say I didn't trim enough or aggressively enough. And I had my reasons for, one of which you're calling out, the taxes and the timing would have, it felt, I convinced myself that it would be silly to cut given all the momentum that was behind the company.
So so let's just close out your final conclusion. So you're going to stay on board, and it sounds like you're going to give this management team more rope. Are you going to tweak your allocation so that if they let you down again, it doesn't hit you inside so hard?
At this point, I think the market tweaked the allocations for me.
That's fair. Okay, that's very fair.
Unfortunately, I mean, the drop, so at this point, the valuation is, quite reasonable. And if they're at all successful in fixing these issues, which they said they did, then all of a sudden I'd be actually buying here rather than selling.
Okay, fair enough.
So it's now going to be just market price action, do institutions believe that this is the low point for this company? Because really, we just lost some time. Nothing really broke besides trust and management.
Which is very important, but yeah, okay.
Yeah. So I guess I hope for our EOS investors that that's enough of an overview.
We got three uglies to tackle this episode. I feel like, you've put your heart on the floor. Maybe I should go next, and then we'll come back to Oddity. Just to
Let's do it.
Give you a break, emotional break for you.
Yeah,
so go on,
thank
hit
you.
me.
Thank you.
Hit me, because you basically threw some chart at me about Mercado Libre. Go on, hit me with your allegations.
The allegations were quite simple. I, as a former MELI shareholder, know and love the company. I regret not having it in my current portfolio. I'm in tune with valuation. I see that it's a good buy. So I pull it up on my Robinhood. I'm browsing, just thinking loosely. I pull up the chart. I hit the 5-year time frame. And to my great shock, I see that randomly, it's random, I decided to do it on whatever day, February 27. 5 years from 2021 to 2026, Mercado Libre, this great company, over those 5 years actually was down something like close to 6%. And so my thoughts in that moment were, holy cow, I did not expect that to be the case. Secondly, I thought, wow, if the actual stock price lost 6% over 5 years and the S&P is up by however many percentage points, objectively speaking, that's a bad investment outcome. Third thing I thought, Badge, before I turn it over to you, is that 5 years is not a drop in the ocean. 5 years is, I would say, all long-term investors say, that's kind of a decent measuring stick. If you're losing to the market over a 5-year period, something not right. So that was the shade I threw at you, and curious to see how you respond to that.
That's very fair. Like, that's just the reality of the company. And you're right, 5 years, like often we talk about, the stock is down, and my kind of excuse is zoom out. You can't look at 1 quarter, 1 year. 5 years that's very fair time frame to judge a company by. And I'm not going to make excuses for this one. I kind of don't care, right? I feel like this company is actually in great shape, and I think the valuation is pretty reasonable. Like, if we ignore the stock price and the market cap and we just look at like some of the metrics that matter, gross merchandising volume is up and growing at an escalating rate. And then here's this pretty picture from our friends at fiscal.ai, just looking at revenue as one small thing. Revenue is up and growing at an accelerating rate. And here's your 5-year time frame. Revenue is like more than a 400% gain over that 5-year time frame. And yeah, there are reasons why the market is concerned about them right now. A few years ago, it was inflation in some of the core markets. Right now, it's kind of concerns about the rapid growth of the credit portfolio. But if you dig into how Mercado Libre are managing the credit portfolio, it's actually quite healthy. Net interest margin after losses is growing. That's a good thing. That means like they're making more money as a proportion of the total loan book. The sort of losses on bad loans is decreasing, so they're improving the quality of the loan book. So there are things to watch there, but maybe the market's being quite pessimistic about that. And then the other thing that the market's not really happy about right now, but I frankly love, is the fact that the company is just burning capex on building out its logistics infrastructure. So if you were to look at this just based on a pure, just pure numbers, then it probably looks quite ugly because the company's spending a lot of money. But what they're buying is a much more robust footprint. So one small example is they've been able to very recently announce that they can reduce the minimum cost of an order that qualifies for free shipping. And so they've done that a few times. They did it again quite recently to reduce it to I can't remember, 19, whatever the local currency is. And then that in itself is causing people to buy more because they can get more, smaller orders for free. So it's expanding the market. And as they expand the market, they're increasing their revenue on goods sold or, third-party sales and first-party sales. And they're massively increasing their fintech revenue because these things are a really nice flywheel that work together. So the company's in like investment mode. The market don't like it. It's very similar to the Amazon story a bunch of years ago. And when they come out of investment mode and they turn back on, like the profitability pipeline, I feel like there's a lot of potential built in here. So I'm kind of happy with the company.
All right, Badge. Let me squeeze your shoes. Let me do to you what you did to me in good faith. And I think I have the proper spin on this. I think you're making an error in one fundamental sense when you say, you said something like, I feel this is a good company despite what the price did over the last 5 years.
Yep.
The critique is 5 years is a long time to feel one way, but the objective, literal outcome being red is not a reason to feel good. It should be, I feel bad that this is a good company and I've lost money over such a long period of time. I'm not saying this is you.
Let me just fact check that, because I want to throw one more graphic into the mix. But I hear what you're saying, and I want you to finish that thought. So I have bought this company 7 times now, initially in 2019, most recently last Christmas, December 2025. And here's an extract from Port Saito, which is, like as close as I've got to like an audited portfolio history. So actually, the column that you're interested in here is the excess total return. That's like the percentage return beyond like the S&P as a benchmark. So like if I look at my first 3 purchases, one is up 40%, one is down 44%, one is up 7%. And then my most recent 4 purchases in the last year and a half are all like significantly underperforming the market. Overall, I'm up pretty nicely, because you can't see on here, but like those early purchases were kind of much larger in terms of number of shares.
Yes, that's every investor's journey is different. You added a point. So I get that. I was talking right in the abstract 5 years. So this is why I think my reframe is important to consider. You could either say 5 years is on the short end of my time frame. If you want to, now you're saying I invest in 5 and 10 year blocks, and therefore 5 years is just the halfway point, and that's why I'm not concerned. But now, obvious asterisk is not everybody has an easy 10 years, or, like that's getting into mortality territory. But potentially you might die before your company makes good. And so I think the more accurate way I would phrase it is, I'm disappointed that the company of this quality has underperformed over a long duration. But because the fundamental metrics continue to be sound, I expect a rebound over the next 5 years. However, it's unfortunate that it's taking so long, and that capital would have been better allocated somewhere else or something like that. I'm just pointing out the feeling versus price action, and here I want to give more weight to what the price action was. And this is right. This gets into the technical analysts versus the fundamentalists, and the technical analysts all day will say, we don't care about your feelings. This was a bad investment over that time frame, which is arbitrary.
Right. It's not arbitrary, it's correct, right? So, any purchase I've done in the last 2 years has been a bad purchase because it's seriously underperformed the market. That's just a fact. But like, as you said, like the argument, put my feeling aside. If you just look at, say, I'm a fundamentals guy, and you're leaning on the technicals thing here, but I know you're fundamentals and technicals. Technicals bad, fundamentals great. In fact, almost superb. So that's kind of the reason why I feel okay about this, because the fundamentals support the fact that this company is actually pretty good value right now in a market that recently you couldn't find a bargain anywhere, which is why I was adding to Mercado Libre. Like now there might be bargains because like the SaaS apocalypse and everything else we've talked about.
Yeah, and of course we know lots of examples where the company was flatlined for years and years and years as that pressure of the value kept increasing, and all of a sudden there is that massive inflection point. That's where, though, to argue against myself, that's where the technical people would say, then you just wait until you see that inflection point happening, and that's when you go in, rather than sacrifice 5 years of underperformance. Because you like the company, but that gets into a whole conversation I don't think we need to have right now, because that's timing and all sorts of other things. What is your, say, moral of the story that you're going to take away from this back and forth about owning MELI over the last 5 years?
I mean, call me an ostrich if you want, and sticking my head in the sand. I'm actually happy with the way I've played it. I haven't got any concerns.
Okay. There you have it, folks. I'd love to hear. Yeah, no, I can't wait to hear what our Patreon community and our YouTube folks say, because I could see both sides of it. I think I'm leaning heavier on you still don't want to lose money over 5 years as being not something to feel.
I've lost money over, say, 2 years, because those were the specific. If you treat each of these 7 purchases as like an atomic thing.
That's right. This is why it's a little messy, because your personal situation is different from the abstract one I was looking at. All right. So what? More ugly from me?
Sure. Remind us, so you're going to tell us about Oddity. Just give us a quick reminder on who Oddity are and what they do. This is the makeup guys, right?
Yes. So I made a fancy slide deck. I'm doing a very deep dive on Oddity, because I think this is potentially a massive opportunity that the market is giving us. And I was, believe it or not, very, very tempted to add this morning before we recorded, but the technicals unfortunately didn't allow me to do that. So I'm following my own medicine. But here's why I'm fascinated by this company. If editors could call up the first slide, record year meets technical storm, there you kind of have the thesis statement in what happened all in one sheet. Record revenue, 25% year over year growth, very high margins, 72.7%, earnings positive, free cash flow positive, and massive balance sheet, $776 million on the balance sheet. Really, really superb company, I think, in terms of massive TAM, just quarter after quarter, just expanding, growing fast. They're about to announce a 4th brand, everything to like here. Already, I thought it was cheap. Actually, technicals stopped me from buying more, because I feel it's cheap, but it keeps dropping and dropping and dropping. So I'm waiting. Then we get the last earnings call, and there's this massive bomb that on that day they lose 49%, and it's gotten even lower since then. So technically speaking, as of right now, it's valued at $685 million market cap, with, if you do basic math, $776 million in cash, though there's a $600 million debt note, by the way. Okay. It is 0%. It is 0% due in 4 years. So it's not, you can't just wish the debt note away, but it's really not going to be an issue. 4 years is a long time for a company growing this quickly. So to play it sort of neutral, I'm saying they're financially well positioned, where the enterprise value is something like $500 million, right? Trading, in other words, the market is basically saying this company is worth very, very little at this point in time. Why? What the hell happened, Badge? What happened is they went on the call, again, did not announce it ahead of time, and said, I'm paraphrasing here. Actually, here's the explanation. They offer a try before you buy model to consumers, which I actually think, and they say is, has led to really, what's it called, robust retention, and customers love this. They get to buy the products for free, keep it if they like it, return it if they don't. That's really pro-consumer. That's Amazon kind of thinking, right? Make the customer happy. But something happened during the quarter, during the last 90 days, where the algorithms, they wouldn't name it, but it's pretty obvious that it's Meta, tweaked their algorithms such that the try before you buy customer model were degraded in terms of their rankings. So they were basically, it shifted somehow from we want to show these ads to these are lower quality customers, which led to them basically needing to pay more per customer acquisition, right? Unit, CAC or whatever it's called.
Yep.
So at the moment, what the suits told us is that at these current economics, Oddity is not a profitable business because that algorithm, they call it dislocation, is so bad that it needs to be fixed right away.
That's horrible, isn't it? The fact that your whole business model is so reliant on like a third party like Meta or, whichever advertising platform, that a change to the algorithm can smash your customer acquisition costs, which can like pull apart your business model.
Right. And this is why this is where you and I could maybe talk through this. My paws are hovering over the buy button, but not yet. And here's what I need to think through, or any investor here needs to think through. Like EOS, the error seems to be, in hindsight, how do you just have one, call it supply line, right? EOS didn't have a choice because they're literally a hardware company, right? They only have one building. They're working on line 2, but that was the risk, right? So they're not, sorry to go back to EOS. It was dumb. How could you be the CEO and not have backup suppliers, for God's sakes, right? But the same issue here. How can you somehow have been a $4 billion company at one point and only relied on one advertising channel? That's the critique, right? Dumb.
Right.
But now going forward, okay, so the market completely sold off the company to the tune of 70% since the earnings call, or massive, right? It was badge from the highs of 77 down to $12 at the moment. That's like insane. What the market is saying now, and by the way, I'm going to return this to that first slide. They're profitable. They have, this is a growing, healthy company. To basically
they were profitable, right? Because you said they weren't.
Well, technically, as of last quarter, they're profitable. They're positive on all the metrics and growing. So the question for investors is, what about TikTok? What about Snapchat? What about, I don't know how else you advertise, but what laws of physics say they are only bound to Meta? And also, there's a lot of institutional ownership. Insiders own this company. I'm having a hard time arguing against myself, saying these guys are just going to now sit on their hands and say, well, I guess we're stuck with the one channel and, we could better pray and hope that Meta helps us, figure out the algorithm thing. I don't see that as the reality. They're going to fix it. It's probably going to be an ugly next quarter too. But the problem, Badge, I don't know if you have additional insight here. I don't know enough, about how those intricacies of algorithm mystery, how they work. How long does it take? Like, what do they get to call up a Meta? I'm sure they have an account, right? This is hundreds of millions. So it's not like they're small fish. They're going to talk to people. How does that get unresolved? Or does it get resolved? Is this an impossible situation when now they're dead, like one error and you're completely screwed?
I don't know. I know no more than you, but if I were to think okay, like Meta have tweaked the algorithm for some reason, and they wouldn't do that arbitrarily. They're doing that to maximize their own bottom line. So they're trying to deliver value because they still want, like, their Meta's customers in this case are the advertisers, but they're sort of pivoting and maybe if you're in different segments and selling something other than makeup, maybe suddenly, your advertising might be a bit cheaper. I don't know. So should the company like have multiple advertising partners 100%, and Meta own like a lot with like Facebook and Instagram and a bunch of other stuff? But yeah, there are alternatives like TikTok and Google. Maybe Google doesn't hit your market as easily, but I would think TikTok was a similar market to Instagram. But if Meta have made those changes because of some evolving market dynamic, maybe TikTok are seeing the same thing and they would be making the same change.
It's okay. Maybe I'm going off of the most reasonable path forward, which is that explanation, which is that this was a misunderstanding somehow. By which I mean the try before you buy program is actually a good thing. The algorithm read it as a low quality thing. And that mismatch will be fixed and communicated when the people in charge of these accounts basically understand or explain the dynamics, right? That's my going thesis. What I didn't mention also, Badge, about this company is that most of the people who buy one of the brands are returning customers, 70%, I believe. So their cash flows are already locked in. Most customers don't know anything about algorithms. Once they bought, right, they're already in. So the cash flows are going to come back. It's just how fast can this be fixed? That's where it's a little bit of a black box to me. And it seems borderline inconceivable that this does not get fixed. It's just like, how soon? And could the market sell this even lower? That's what the technicals are for, right? The technicals are saying right now, you shouldn't touch this thing. Although interesting, it's recovering in the moment. But you know what? Side note, I want to read a Warren Buffett quote. And this is what makes this even trickier. Buffett says, if you're a young investor and you can sort of stand back and value stocks as businesses and invest when things are very cheap, no matter what anybody is saying on television or what you're reading, and perhaps if you wish sell when people get terribly enthused, it is really not a very tough intellectual game. It's an easy game if you can control your emotions well. So basics, let me sum this up for anybody listening. I'm seeing a really strong company, black swan event that I don't fully understand. It's not, if I were to buy this for King of the Jungle, portfolio would not be out of impulsivity, would not be out of emotional. It's because I've considered carefully the numbers that are in front of me, and it feels like a temporary, huge opportunity to take advantage of something that will be inevitably fixed. For me to not take advantage of this feels like I would be giving into too much to loss aversion or, risk aversion. Or I would have to say the black box that is advertising is so beyond my understanding, and I'm only hoping that it's going to get fixed, but it's like, who knows? So I stay away for that reason.
It's like a different kind of trust in management. It's not like you distrust them. It's like, do you believe that they have the capability to now learn from this error? Sounds like they made an error. And can they now, fix that in some way? And if you trust in their ability to navigate that successfully, then there's not like an ethical or something like that kind of issue. It's just like, it's a capability issue.
Right. And to that point, in doing this research, there was a big thing when Apple, I think it happened around iOS 14, started saying, that warning you get now when you buy an app, it allows users to not be tracked. Companies like Oddity that was another black swan moment, and they navigated that successfully. So management has done this before. Here's what I'm going to say for the record. I would be disappointed in myself, I think, if I let the fear right now overwhelm what I think is a clear, huge opportunity to invest in this market. And to be determined how I take action. Right now I'm watching the charts, but that's where Monkey stands.
Yeah, that sounds fair to me. It's a kind of small company. It's in its niche. Like, things can hit small companies and disrupt them. And sometimes it's in the control of the management team and sometimes it's not. And so, that's why we manage, I'm going to come back to allocation again. That's why we manage our allocation to the smaller, much more volatile stuff so that it doesn't make us feel exuberant or sick when something crazy happens. I've got no concern. I'm certainly not going to throw any sticks and stones at you for saying this might be a really good buy right now.
Yeah, and on Patreon, we had a conversation about Oddity. It was, I'd like to mention this. This is where my process works well. As I was learning about this company, I bought one share at $36 because at the time that felt really, really cheap. And then I used my technicals for that, and then things went even lower. So the selling pressure continued, and I refused to add because of the technicals. And now, as I'm looking at it, it is a little bit of, at what point do I override the technicals because the fundamentals are so obviously asymmetric? And that's a difficult question. That's where I'm basically trying to juggle the two worlds. And those who are really risk averse would say, yeah, you really wait until the buyers step in. That proves that we've basically had an exhaustion of the supply. And so we don't quite know when that will be. So for now, I'm holding off.
I know nothing about the numbers of this company other than what you've shared in your 2 slides today. If putting aside the operational cost of marketing, which sounds like it got away from them, if the actual product the company is selling is profitable, on a unit cost basis, and if the company is trading at less than 1x sales, then, some of the important fundamentals are kind of on your side there.
This is what's wild. I can't wait to have this conversation a year from now, because again, everything will be in hindsight. When you have this much growth, this much profitability, this much room for expansion, and valued as, basically close to cash, that's one of these fat pitches that, unless, the algo thing is way worse than I understand it to be, these kinds of fat pitches are rare in the market where, it's only now the fear portion. So, I never thought of myself as a makeup guy, but that's the other thing is that's only one of their lines. They expanded into acne and dermatological telehealth stuff, which is a huge market.
Don't say telehealth. Don't say telehealth. You're cursing yourself.
Right. Yeah. But no, this is, anyway, for all our listeners, if you have not yet done a deep dive into Oddity, Monkey put together, with the help of his AI buddy, he worked a really long time on this Oddity slide deck, which he will upload somehow on the Patreons for y'all to take a deeper look at this company. It's a fascinating moment. So TBD.
Just while we mention the Patreon, if you're on there and if you were a free member, apologies, we've now locked you out of all of the chats and you can't see anything on the Patreon anymore. We wanted to support our free members, but sadly we had, within the space of a week, 2 OnlyFans attempts at scamming our Patreons. So we've had to lock out free members. So, it's going to cost you $3 to become a sloth, and sloths get access to see everything and chat. So it's all still there. And Monkey's slide deck will be all there for you, for us sloths and above, I'm sure.
All right, Badge. Yeah, we're getting more restrictive. We don't want no monkey business, except for your chief monkey. The chief monkey gets monkey around, nobody else.
All right. So look, we did one tiny bit of good. We did 3 bads. Should we have a look at one ugly, which is, if you're on the Patreon, you'll be very familiar with the beautiful King of the Jungle portfolio spreadsheet that Beaver built for us. This is not pretty, Krzysztof, and it's the consequences of being suffering like massive drawdowns in such a huge position. You were so far ahead over the last 1 year, year 2 of King of the Jungle. You absolutely dominated the competition with something like a 360, 370% annual return. And you streaked ahead of me in terms of your overall portfolio value. Ooh, this is pretty ugly. Look at what's happened just in the last, since the start of this year. We're almost back to parity.
And that's one way of looking at it, Badge. I don't like losing such a big lead. So that is ugly from that perspective. But if I want to take the other side of it, is since inception, Monkey's still winning. So yeah, there's some massive peaks and valleys here. And this is, my strategy is not for the faint-hearted, for sure. That's why we make a great team. You have the solid sort of sloping upline. I have the much more aggressive peaks and valleys. At the moment, my strategy has so far been the objectively better one, but there is, how about we say this? There's both good and ugly all in the same chart.
When you're following like the yellow banana line on like the stock chart like this, your portfolio value, you've got to have nerves of steel to basically operate a portfolio the way Krzysztof does. And it won't be suitable for everybody. And you'll have those, crazy years where you like 4x your portfolio like you did in year 2. And then you're going to, the counter side of that coin is, when things go bad, they go bad much harder for you because it's the nature of running like a much more volatile, high beta portfolio. And if you ain't got nerves of steel, you kind of do it something like the Badger way, where when things go up, you go up, and when things go down, you go down, but, within a certain kind of range.
Let's wrap this episode up with something I put on the docket that really stuck with me all week long. And I actually talked to my students about this. I showed a clip of an interview with Alex Honnold. He's the guy that climbed Taipei 101 without a rope. And that wasn't the most dangerous thing he's ever done. But I began to reflect on what he says in the diary. It was an interview with the Diary of a CEO, which is a terrific program if you haven't seen it. He says the crucial question is not how to climb without fear. That's impossible. But how to deal with it when it creeps into your nerve endings. And what he was telling the host was, I've been doing this every single day, 5 days a week or 6 days a week for my entire life. Meaning I've been climbing in fear for that long. So it's not that my brain doesn't have fear. It's that I've learned what fear is and I've adapted, literally, my brain has adapted so that, like you do anything, right? You change and you kind of have a different relationship with that thing. I think because you and I have been doing this for so long, I've gone through these kinds of situations so many times. It's not that I'm happy. It's not that I don't feel anger as I expressed to you, or disappointment or delusion. But I think I hold fear. I don't know if better is the word, but I'm capable of containing my own fear in a way that doesn't lead me to either freak out or make impulsive decisions or say this investing thing's not for me. I just know it more intimately, so I let it run through me more easily. And that might not be the case for everyone, but you do something long enough and you get better at it.
Yeah. Yeah. Like it comes down to like know thyself. If you know you can handle the swings, then, you demonstrated, yes, you are right. You're still ahead. Maybe that is the more profitable course if you can handle the drawdowns. But, if you take a risk that possibly prevents you taking future good risks in the future, I think that's like some mishmash of a Morgan Housel quote, then that's probably a bad thing to do. You don't want to get wiped out of the market, which could happen in two ways, right? You could, if you're using leverage and margin, you could get wiped out because you go to zero and you've got no money left. But also you could get kind of blasted out of the market because you take such a severe drawdown in a short period of time. Like you said, you just like, this is rigged, this ain't for me. And you kind of step away from like an activity that if you get it right, will change your life over the long term. You just got to find your own way.
And this is like, it's not, you're right. You don't get rid of fear. We're human, right? We're going to feel it. It's not about volatility. It's not about avoiding being wrong. We're going to be wrong. It's like, how do we develop a relationship to that fear that allows us to act reasonably in the face of it rather than emotionally and irrationally and so forth. So that's a subtle point, but most people should sit with that a little bit longer. Like move into the fear, practice with it.
I really like the trajectory of our conversation today. I don't know if we lucked into this or, we're just sort of quiet geniuses in the way we structured the docket and changed it in real time. Like that's quite an interesting journey looking at a couple of, arguably with nuances, failed investments in both of our portfolios, and then navigating to like really our core disciplines around like managing your portfolio in a way that works for you and being resistant to the extent that you need to be resistant.
Yeah, I love this conversation. Goodness, it was good therapy for me. I hope for our investors, we actually have 3 really good investing ideas come out of this right now. To reiterate, EOS, EOSE, Oddity, ODD, and Mercado Libre, MELI, are really, really fascinating opportunities if you do your due diligence, take the time to explore why that might be the case, and go start your work.
Yeah, and look, like your work could start very usefully with a tool like Fiscal.ai, which we're big fans of. And I showed a couple of Fiscal AI graphics for Mercado Libre. I know you use it alongside tools like TradingView to look at.
Actually, Badge, sorry, I forgot. Sorry to interrupt you, but I did not allude to the Oddity Fiscal AI chart as I was talking about it, but I am going to include that. And then I'll also paste it on the Patreon, but I did want to let our listeners see the basic numbers for Oddity Tech, which used Fiscal AI, and the awful chart that accompanies it.
Yeah, look at that red graphic. It's dropped off the bottom of the chart. What's happened?
So yeah, Fiscal AI, right? It's yes, we use it all the time.
You can get a healthy discount by going to fiscal.ai/wildlife, where you'll get 2 weeks free of Fiscal Pro, no credit card needed, and a 15% discount if you upgrade. Like it's part of our essential investing toolkit. And hopefully when you look at your Fiscal.ai graphics for the companies you're interested in, they won't be like red lines disappearing into the ground. There'll be some green in there. But, investing is a lifetime long game. You can't let one failed investment like wreck your plan.
All right, Badge. So if you're ready to be a beast of an investor, where does the journey start?
One of the places it starts is with the number 19 best investing podcast in the world, right here.
Sweet. Hurrah.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.